Hey everyone, it's Imran from Options Insight with your macro options spotlight for today. Okay, so if we look at equity markets drifting lower in the US especially, but Europe as well. We've got some weaker earnings out of Micron in the semiconductor space and Target as well in the retail space. So whilst Walmart wasn't too bad and the stock rallied quite well, Target having a bad day and the outlook not very good basically for the holiday season. We also had poor housing data out of the NAHB. That's kind of been a trend that's been ongoing. Obviously, we all know the issues in the housing market with higher mortgage rates, but there is a question like, is that housing data then going to feed through to initial jobless claims and basically throw us into a recession sometime middle of next year? That's what things are kind of pointing towards. So market's not necessarily in love with that. Commodities also drifting a bit. But we did see uranium get whacked the most, down about 4%, or the uranium sector. So we look at URA, which is a blend of the underlying, and also some of the miners. So that's kind of our gauge for what uranium's up to, and that was down 4%, which is a reasonably big move for the day. The 4,000 level on the S&P, which has been holding for most of this week, starting to lose its pull as markets trade softer overnight. The dollar firms up, and we've just had Bullard on the tape talking about rates potentially getting between 5 and 7%. Which was a bit of a gut check to the market that was trying to price terminal rates below 5 and getting comfortable with that idea. They might have to rethink that. And this is something we've been saying for a while, that don't get too excited about the Fed pivot just yet, because some of these hawks are going to come out and start counteracting what some of the doves have been saying. And there's not a lot of agreement within the Fed, it looks like right now. There's two camps in there. And now right now the hawks are talking and the market's not liking it. European vols catching a bit of a bid. We've been saying they've looked cheap. They're starting to find some buyers, probably not because I'm saying it, but just because the market is getting a bit low there. VIX vol got whacked though. You saw VIX vol down 6 on the day as the only thing really down significantly in equity space. VIX just isn't realizing, right? It's realizing about 60. It's got some positive carry, which you can't really find in a lot of places right now. And we've got Thanksgiving coming next week. So people may be looking for some theta there, maybe using some of that theta that they sell in VIX to finance some longs elsewhere. They don't want to just be bleeding theta into the Thanksgiving holiday. Commodities vol generally weaker, but we did see a little bit firming up in uranium because of the move. And then nat gas still on the moon at around 110 vol. And that's one of the trade ideas today. We'll talk about that in more detail. No clear message in skew. US skew drifting back a bit. It's had a good couple of days. That's pulling back, whereas European skew's bouncing in line with what volatility is doing. We had said FTSE skew looked crazy cheap. It had a bit of a bid yesterday, up around 1.25. So that recovery. But still, on a percentile basis, all these skews are looking pretty low. We then move over to the rest of our dashboard. What do we see? FX wise, bit of a stabilization in the dollar overnight, obviously on the back of what's going on in rates and what Bullard's been saying. But cable has been pushing towards this 120 level. It did touch above 120 and came back. All eyes are going to be on this budget that comes out from the UK to decide how they're going to raise the money to be able to bail out some of the these high energy prices and things like that. Basically, we're looking at a load of austerity and a load of tax. It's not going to be great for the UK economy. And likewise, I don't think it's going to be great for sterling. So I think sterling's kind of getting to the end of its rally now. Once this news hits, if the dollar just firms up in general, like I suspect it probably will, because it's looking quite oversold, I think cable's got a good five big figures of downside in the not too distant future, I'd say. So on the back of that, I've been doing various trades, buying risk reversals, things like that. I think that trade makes a lot of sense right here. I don't really see a lot of upside past 120 in cable. Vols firming up ahead of this budget, obviously in cable, up 30 bips, where FX vols in general were drifting slightly. But at these levels of vol, they're not going to get absolutely hammered. Bond volatility, a bit of an offer in HYG, whereas a bit of a bid in TLT, as TLT managed to rally 2% yesterday. So had a really strong day. As yield curves are inverting further, that 2-10 curve in the US going to levels we haven't seen yet, like 67 basis points negative. We talked about this a while back, that this thing could go to minus 100 as the front gets anchored in the fight against inflation and the back just follows the fact that we're going to go into a recession. And that seems to be what's happening right now. So that recession signal seems to be blaring right now. Like carry-wise, all a wall of red still. That's because it still captures those big moves that we saw last Thursday. We are probably going to have a quiet week next week as we head into Thanksgiving, I suspect. But bear in mind, liquidity tends to evaporate as well. Liquidity has been quite bad all year. just in general asset in to trade. So next week, it's not about to get any better. So if we do see news hit the tape out of the blue in a quiet, illiquid week, then you could get exaggerated moves. I suspect that's not what's going to happen. I think we've got maybe a week of quiet next week before all the data kicks off. We've got PCE, non-farm, CPI, and FOMC all in the first couple of weeks of December. And then obviously we've got the Christmas period after that. But I think, strap yourself in for an exciting December and enjoy the quiet while it lasts if you do get some quiet next week for Thanksgiving. Skew-wise, not a lot going on in FX and bond skew. We are seeing a bit of a bid in ARK skew coming back as ARK got whacked 5%. And that's a bit noisy, right? I mean, when you on a day when TLT is up 2%, you're not generally going to see ARK down 5%. They tend to be quite well correlated because what the yields are doing tends to filter through to these high growth, low earnings, long duration names, but ARK really getting whacked. And I think it's on the back of maybe some crypto headlines. BlockFi have come out, filed for bankruptcy. And now Genesis Trading, which is a big player in the crypto market, providing, essentially banking type services to institutions in crypto, that they look like they're in a world of trouble in terms of what happened with FTX, and they've got a big hole to contend with. So these sort of things probably keeping a bit of a lid on some of those ARK names that are invested in crypto. Okay, what else are we looking at? Upside down markets. So what I said here is just generally, we've had this 11% rally, since the lows in October, and it looks pretty similar to what we saw in August. And what's been happening this year is in a normal market, like a bull market, you tend to look for signs of capitulation when you're in a correction. So bull markets correct, they have their moves, whatever they might be, 10%, 15% corrections, and then you look for signs of capitulation. This year, it seems to have gone the opposite way. So those signs of capitulation are happening in rallies, right? So the type of things we want to see is, big shifts in implied volatility and skew, just like the call bid that we got that was so extreme ahead of that CPI is almost like an upside capitulation, okay? The degrossing that we're seeing of long short positions and some data out from Morgan Stanley showing that, we had the similar sort of degrossing across the books in terms of, closing out longs and shorts, because gross just means when you've got long and short, you add the size of your long and short together. That's your gross exposure, even though your net exposure might be zero because you're long one thing and you're short another thing. So, we had that big momentum shock that I mentioned yesterday, which just blew up people's longs and shorts. And you've had this big degrossing now where people are just like, what, we're getting close to the end of the year. We just got blown up by this massive move. Let's just shut the books down. That smells of capitulation. But you're seeing that in a rally scenario, not in a sell-off scenario. So what that means is we might be getting closer to the reversal of this bear market rally because you are getting these sort of capitulation signs that in a bear market, you'll get on capitulation rallies rather than capitulation sell-offs, right? So that's the observation that I'm making there. And then S&P, that top end resistance downtrend was coming in, a little over 4,000, similar to the 200-day moving average. And that's kind of where it ran out of steam back in August. So a lot of signs pointing to the idea that this short squeeze is getting a bit long in the tooth. The question really is, have we seen the max pain yet now that we've seen a load of degrossing? Or do we need to see more pain from the CTA community that get forced back into the market at a higher level? So, we'll find out if we get this Santa rally or not. I'm probably leaning towards the camp that we're not going to get a Santa rally, but there may be one last thrust higher to cause max pain, and then we come off. That's really the question. Okay. Anyway, if we look at volatility and what opportunities I'm seeing in vol space, so the thing that really standing out to me right now is commodity vol. So when I look at commodity vol, there's two standouts: natural gas, which is the red here, and uranium. So in terms of where they're screening cheap and expensive, nat gas is screening super expensive and uranium screening cheap. And that's versus their own history, versus where their own implieds have been. Okay, not versus the absolute level, because if you look at the absolute level, then the lowest vol is going to be something like gold, right? So anyway, so that's what I'm seeing. Uranium versus nat gas is an opportunity. In terms of where their spot prices are, they're quite neutral. So we don't have a strong bias either way in terms of spot direction. So we think it's more of a Vega trade, a vol trade, than it is a delta trade. So I had to look a bit closer at this to see where the levels are. And thanks for listening, everyone. Catch you all tomorrow.